Good evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for the evening of Wednesday, and we're at the 7th of December, 2022. Okay, so what I think is going on and has been going on is I think, as I said to you this weekend, and I said it yesterday, I think the market got it all wrong on the jobs data, and we're being paid back as you're into 5 days in a row down. In most of these stock indices are down to the lower Bollinger Bands. They've given up most of all that rally that they made. And the markets, I think, come to terms with the fact that, just darn it, this economy's too strong. The reports that keep coming out don't show that the lag effect has kicked in and that things are weakening markedly. Coming down a fraction isn't going to do the job for the Fed. It's going to keep inflation higher for longer. So the market is now, I think, saying, we've marked some time, we've given back a little bit across the board. Maybe we take a look, and come Friday's PPI and this coming week's CPI reports, we see what those two are offering, and that will tell us into the FOMC meeting what's going to give. This FOMC meeting on the 14th, you don't get another Fed meeting until February. So the Fed has to, in this meeting, set the pace for what they think the lag effects will take into place. I know most traders are hoping for 50 basis points. I'm all by myself. I think they should stay 75. Why not? You go down when you see the impact working. Where's the impact? Now, we're going to get employment claims, so that's going to be a good piece. Let's see what's going on. Are they going to markedly rise, or are they going to drop again? If they keep dropping, you just have too strong of a labor market. I think it's a no-brainer. If I'm on the Fed board, 75 points. We can always lower. But if you lower now, you tell me in February we're going to go back up, what is the message then that we're sending? So that is the dilemma. The dollar doesn't know if you get to 75 points. Is that bearish the dollar? Does it mean we're going to strangle the economy till we get what we want? That's one way to look at it. Then all the other people are looking and they're going, well, whatever America does with interest rates, regardless of what they want to do, they're caught. We are the big boy, and what we do forces them to do things. I wish I could tell you it's not that way. It is that way. When we look at bonds and notes, have you not paid attention how the yields are coming down? I mean, the headline today was how it went with mortgages, how they have fallen back to around the 6.4 level. Toll Brothers beating everything. But look at who Toll Brothers sells to. It's not the general public. The people that come into Toll Brothers are building typically custom homes. They got mainly cash. They don't need much financing. I've said that's how that part's going to work. You're not hearing that the average home is going out there. Then I look at what the grain market's doing. Now, we have a U.S. supply demand report coming out. I think you want to pay close attention to that. The government sort of tripped everybody up when they made changes on renewable energy. Let's say how they use soy oil and some of the other oils, veggie oils in that. And they flipped the meal crush spread. The meal took off and the oil went into a crashing stage because of it. Okay. One last thing. We got down in the crude to the $72 area. Is the government stepping in at that zone? You say something and markets have a way of testing you on it. Is it going to be there? Is it going to be the $65 range? Where are we going? You made new lows for the year. I can't believe I'm saying that in crude. So when we look at the S&P, we're in a corrective mode. We seem to be wanting to come back towards the 18-day average of closes. The pattern of the market, you're still very much caught in all this nonsense that we've had going on. And this began the early part of November. And you really haven't gone anywhere, okay? I've had very few trades in this index. You're not getting the setups. And I keep looking at that. You still don't have one. Take a look at this. You have a higher high, lower low. But you had these patterns that didn't go anywhere. And when they were coming in for buys or sells, you were so close to the objectives as they happen in these narrow ranges, there wasn't anything to do. So now the market with the past 48 hours has come down into the 100-day average underneath the 18. So Before I had said I think we were fighting a battle from the 100 and the 18 up to the 200. Now I have to change that. Are we going to let go here to the downside? And if we do, what does that open? Well, that opens the Bollinger Band for 38.97. And my gosh, we're just about on top of it today. If we come back one day here, the low was 39.14 and the Bollinger Band bottoms, let's call it 39.07, 06.75, right in there. That's where that's sitting. So that's what you're doing. You're probably spinning your wheels, marching and watching through time as we get into these final 2 days this week of some data to make decisions on. Would I be telling new clients or existing clients or even anyone I know on the street, you go short when you're oversold? No. You're into the support of the 100-day average, the lower Bollinger Band without a trend. I'll let somebody else carry the weight of the market. When I come to the NASDAQ, it's pretty similar. I'm down to the Bollinger Band. And this one, if we take a look together, that number was at 114.35 and you got to 114.23. You hit it today. That's my point. And you're trying to hold it. So you did get stopped at the 100-day average in this market, thrown back like nothing, got right under the 18-day average. And over the past 48 hours, you're just coming down there. In the Dow, which had been the strongest of the indices, you're giving up something, but to get really to support, it's at 332. 34. So you got a ways to go here, 33,234. That's 400 points away from today's high. I don't know that you're going to get there or not. Are we trending? No. You got a higher high, lower and low scenario. In the Russell, higher high, lower low. Yeah. And again, these markets are all caught in this sideways action. Here's what you should do in stock indices. You take your hands like I'm doing here, you put them inside your pockets, and you go, I'm not going to press that buy or sell button. I'm going to wait and see how these reports come out and the setups that it gives me. To get caught in this nonsense means you go through your money if you're not making money, and you're not ready when a trade setup comes, you can't jump on it. When we come to the VIX, I was reading a report tonight from one of the big firms that's saying, the VIX might go back to 40. You realize 40's up here? They are saying that there's another 25% break in the market coming from current levels. They're trying to give reasons why they think it can come. In other words, they're saying that we haven't felt the impact of the recession, and when we do, you can get a bigger break than that carrying the market. If you will, the VIX would go up, the stock market's down. In the T-bonds, the 100-day average isn't stopping the rally. I'm surprised, very surprised. It just isn't able to do it. The market's at the upper band and it's staying embedded. This is what rules the day, but I really thought that it should have fallen back from there. And I did tell traders somewhere else, and I said, no, I think you take some money off the table at that combination. Don't worry if it goes through. You're never going to pick the top or the bottom in a market. You're in a zone. And I do think that's the case. I think the same thing is true with the 10-year. It's more pronounced here. But remember, when you go to the far back, 20-year plus, as you're going into those treasuries, the market is completely convinced we're going into a recession and that the Fed will have to revert down on interest rates when that occurs, and they're building it into the far back numbers already. If you're looking at the bank index, KBW and some of the others that I watch in the spiders, you're seeing they're getting hurt. And that's because, hey, let me have your money. So I bring a bunch of money to the bank. Well, I want a higher interest rate if you're going to hold it. But now what they can take that money and lend it out for a long-term loan, well, that keeps falling down. That's what's going on. In the eurocurrency, the battleground is right where I thought it. It's still the 200-day average up to the Bollinger Band. This is working as I thought it would. The overall trend remains bullish, but you're correcting in this market. You lost the embedded reading. Now, this is so fascinating. So we come in, and did we ever have the bullish embedded reading? So let's look together and see it. Don't have it there. Both numbers over 80. That was last Thursday. Friday, both over 80. Both over 80 on Monday. Then you lose that reading on Tuesday's close, okay? Now we come to today. You keep it lost. I don't care that we're getting a rally into the market here. That's the point that I'm going to make to you. It means little to me at this point. I'm thinking that the market's going to fight its big battle to not get over 106.06 and then first hit the 18-day average. That's typically what happens when you lose an embedded reading. You don't make a new high, you go down to the closest main moving average. And I cannot count that it's the 200-day. I'd like it to be the other one. It could be. It all happened when you were on it. If it weren't on it, I'd feel much more comfortable. In the British pound, you lost the embedded reading there too, and it's the same thing. You at that 200-day average, you lost it right on it, and it's refusing to get back there. So am I not concerned that you won't make it to that? I am very concerned because if you get the type of reading from the Fed, the numbers that we get on PPI and CPI that causes them to do an action that breaks the dollar, these markets are just going to go. That's what they're telling you. That's exactly the story I'm reading out of it. Bitcoin, I would be staying away. I told you I thought that the volatility came out of the market. Now you're into the churn, as you can see. I don't see a play there. Brent, WTI crude. Look at this difference. You were just weeks ago trading at a differential between them of near $7.70. You're now about $5. And you can see how you have fallen apart in this market. I mean, I still don't understand, and I've been very honest with you, what the cap does when you put it at a price that you're nowhere near for Russian crude. And why is the market breaking under that is another thing I don't get. I don't understand it. Maybe you can explain it to me. I don't get it. But this market has come down. Throw the cap away, and I think what the market is saying is the world is going into a recession. And if the world goes into a recession, do we need oil at this much? Okay, well, I think if OPEC had their druthers and we went back to Sunday, given the break the market has had in the past 72 hours, they might have said, maybe we should do another cut. We'll see. I don't think day-to-day scares them, but I think that they're concerned about the longer term and where that's going. You are down in the WTI first to the point where the market should find support second. You hit 71.75. Joe, hey, Joe, wake up. The boys are supposed to be buying the crude oil. Okay, he'll get the message. Heating oil market under the lower band coming down. But you realize this is great news for inflation. It breaks it. Okay, so energy prices are coming down any way you want to cut it. How long they'll stay down? Well, the charts don't tell us that. They tell us that you're no longer in natural gas pushing $7.70. You're pushing $1, $2 lower, $5.21. You heard me. I went to school, that's 20 some odd, 30% lower. That should be showing up in our pockets, hopefully at some time, as long as the people that supply that to us pass some of these cost savings on. That is the way to look at it. And that is how I'm going to look at it. Last night I went out for a celebratory dinner that I had finished my outside day trading course. And I certainly drank too much, okay? Overslept when I was putting out the morning subscriber video. I rarely miss it, but I know I woke up on time and I said, I'll sleep 10 more minutes. It didn't work. I fell out. Okay, but on the way, I happened to be going by some gas stations and I'm looking at the price. Premium, $5.05 a gallon. I mean, my city car is a smart car. I don't know how many of you know what even that is, but I love it. I mean, I have the hot rod one, the Brabus version. I've had it since brand new, and it's my favorite car. And I've had almost everything. But it takes premium. And the last time I filled up, it was near $6. Now, I know you're going to laugh. Yeah, but how much do you fill up? You don't fill up often. All right, especially living in the city. You don't take this car to take long drives in the country. It's a wonderful city car, but I wasn't ready for that. And that's the only time that I filled it up recently. And I went, wow, that's $1 a gallon less than I just paid to fill it up whenever it was. Okay, you pay attention to all that. And I happen to be surprised. All right. So let's take a look together. One of the things that you should do is get our futures trading kit because it's got everything in it. I mean, you talk about chart patterns. 14 of the most popular patterns are included in this. One of the things you'll see is the cause and effect sheet. I created this when Paul Volcker, I know you're going to say this man's so old, when Paul Volcker was the Fed chair, because I didn't understand M1, M2, and M3. And you probably don't understand it yet. When you're reading the paper, you glimpse over it because the articles in Bloomberg will say people are getting concerned. M2 is doing such and such. Learn what it is. I make it easy. It's in a spreadsheet. It's like in a cheat sheet that you took an exam at in school, right? That's what I do. I make learning everything easy. That's why it took me so long to finish my outside day course. I make seeing all the Merck, their new courses, whatever they come up with, easy for you to get your hands on and work with. So just go to our website. You'll see free offers, or move your cursor up here, give it a click, and away you go. I'm Ira Epstein. You have a great day, and I will talk to you all tomorrow. Have a good one.